China's markets are broken, not the way that the New York Stock Exchange was broken for 4 hours yesterday, and not merely because the Chinese government's using every power it has short of the military to make shares go up either. It's broken because so many stocks are suspended that the indexes that everyone uses to track the market have become completely disconnected from what's actually happening to shares. Consider the Chinext Composite, an index of 484 supposedly fast-growing companies on Shenzhen's Chinext market. The index is up 2.9% today, a welcome relief after it fell by 43% over the past month. But as a measure, it makes China's official statisticians look like paragons of virtue. There are 192 stocks that are on Chinext actually trading, and today every single one of them's up by the daily limit of 10%. You can see the red bar shows the number of stocks that have risen by the 10% limit. The index itself is measuring something which doesn't exist anymore, an imaginary market where virtually all of its 484 companies are available to trade. Because the suspended stocks have stayed in the index, their move of 0 drags down the total move in the overall index, even though every stock that traded rose by 10%. Now, the same applies to the main indices, the Shanghai and Shenzhen composites, where in total more than half the listed companies are suspended. In Shenzhen, of the 710 stocks that are still trading, 699 of them were up by the maximum, with just another 11 that didn't hit that 10%. In spite of that, the index was up by only 3.76%. Now, it's true that some of the biggest companies on the exchange, including Ping An Bank and China Vanke, didn't hit the limit, but even they did very well, and all but one share rose by more than the index's 3.76%. The one Shenzhen stock which lagged behind was the minuscule Wuhan Boiler, one of only 3 companies in the whole country to see their share prices fall today. Now, the 5.5% gain that was recorded by the index in Shanghai is less obviously wrong, because 7 out of the 10 largest stocks did lag behind. Even so, with 647 here of the 690 active stocks up by the daily limit, it's clear that the market was on a rocket ride skywards. Stock picking was a complete waste of effort. Now, just as investors sold what they could to raise cash as futures were restricted and more shares were suspended, when the government went all in to boost the market, traders today bought pretty much whatever was available. So that drove the price of almost everything up outrageously. Now, this matters because when measurement tools are broken, investors who rely on the indices are flying blind. Today illustrated the effects of frozen stocks in holding back the index in a market which is rising. But the same is true the other direction as well. If stocks hadn't been suspended on the way down, they would have fallen a lot further, and that would have dragged the indices down a lot further. We don't know how big the effect would have been, but at the very least, one should doubt that the falls recorded by the index so far are representative of what would have happened without all the suspensions. That's somewhat worrying given how big the falls were anyway. Now, with the government trying its hardest to manipulate stocks upwards, those that are still trading may be worth betting on in spite of all this. But anyone gambling their cash on China's domestic shares should be clear about what they're doing. This is mostly a punt on how much confidence the Chinese have in their leaders to control prices. It's not really investment.